Hello, this week's Woden's Day. Except it's Thursday. It's Thor's Day. Okay, come on. United States of America. Percentage of Americans expressing great deal or quite a lot of confidence in, and then the institutions of the United States of America. This is an interactive chart from the New York Times. So I can't tell you what all these coloured bits of string are, but I've been through them all and it's quite interesting if you go to the link. Right. Cut them in two because there's really only one bit of string that's going upwards, and that's the red one, and that's the military. The United States people are expressing a great deal or quite a lot of confidence in the military. That is going up over the last 30 years. That's about what this chart is going back to, 30 years. All the rest you can see, as far as I can see, all the rest are going down. And that is a down. That's a bad thing. To have a good country, you want the people to have faith in your institutions. There are lots of institutions. I can only give you the one of the three that I've taken in this: banks, US Supreme Court, the church, the military, and you've got to scroll through to get the rest. But you can see the general trend is generally, absolutely, to have less and less faith in the institutions of the United States of America. Not good. I put this in because I thought one of them is, I think, the Fed. I vaguely remember it's the Fed. And one of the things that people say, well, you can always spot a bubble. And the Fed says, well, you can't spot bubbles. It's very difficult. And I can see both sides of that. And just have a look at this chart. This is real house prices going back to 1890, an awful long way. But really, it's the business end of the chart, 1980 onwards. And that's the US housing bubble in red down below. And Norway is the other one. Is there a housing bubble in Norway or not? It's very hard to say. Right, okay. This is from the BIS, 82nd business report. The Bank of International Settlements, the 82nd report that they've put out. No, it's not, because I didn't go for that, because that's huge and monstrous. I've gone for The Economist's and what he calls the dime summary of that report, which is much better, because the BIS thing is thoroughly boring. Okay, so he starts with saying, briefly, a dime summary of the report, and that's the sort of thing we need, isn't it? Nearly half a decade on from the financial crisis. That's nasty, isn't it? Half a decade. 5 years on. 5 years on from the financial crisis's start, many troubling weaknesses in the global economy remain unaddressed. This is the BIS speaking, but him summarising. Deleveraging is occurring dreadfully slowly in many, most all, rich countries. Imbalances, I haven't got time to go into that, have scarcely been diminished. Monetary policy has propped up economic growth. Monetary policies propped up economic growth. Central bank action has propped up economic growth, temporarily buying time for broader structural reforms that governments have failed to deliver. It's only governments that can deliver these structural reforms. The scope for central banks to do more is limited. And the risks of further action are rising because they're going further and further into the unknown. And what they do and the unexpected effects of them are being more and more unexpected, unknown, treading further and further into unknown territory. Meanwhile, government debt is a huge threat. Government debt is a huge threat, particularly given continued problems of undercapitalized banks in some economies. The government having huge debts is a problem because they are supporting banks that are well dodgy. And then we come to the yellowed bit. Somehow, the BIS says, governments must return to budget surpluses, spend less, tax more, in order to maintain market confidence and create room for future bank rescues. Yeah, while remaining conscious of the potential blow to growth from dramatic short-term austerity. The immediate future is all sackcloth and ashes. I think the most important thing there is the BIS saying governments got to watch out, not too much austerity, but enough austerity to get the balance of the government budgets in order so they can stack some money up so they can bail out the banks in the future. That's basically what they're saying. So your services will be reduced, your taxes will be increased, so the government can get some firepower together to rescue your banks. Marvellous. Right. This is going on to the emerging markets. The largest emerging markets, whose economies grew more than fourfold in the past decade, are making losers out of everyone from central bankers to Procter & Gamble, as their currencies post the biggest declines since at least 1998. The BRICS currencies are dropping. For the first time in 13 years, the real, ruble, rupee are weakening, the most among developing nations' currencies, while the yuan has depreciated more than any other period since its 1994 devaluation. Strange things happening out there. Are you going to bet on the emerging markets or the established Western markets? Behind all this, these are China's currency swap agreements. You know, the Fed has got more currency swap agreements going with Europe and the Western world. Swappy, money. China is doing it with this lot of people: Ukraine, Australia, Mongolia, Malaysia, Pakistan, Thailand, Uzbekistan, New Zealand, Singapore, Iceland, Argentina, Indonesia, Belarus, Hong Kong and South Korea. The world is bifurcating. Bloomberg: Brazil default rate at 30-month high raises doubt on economy. Its economy is really weird. I'll just leave it. And it's getting more and more troubled. Poor Dilma Rousseff. Okay. This is from Stephen Roche, who's now retired. So he can talk some sense. And these two paragraphs are very good. I've just pulled it out from an article he's written, I forget where. But if you follow the link, you'll find out. Okay. It starts a bit funny, but it catches up. Talking about the United States. Think again. Since the first quarter of 2009, when the US economy was bottoming out after its worst post-war recession, exports, this is the big word here, exports have accounted for fully 41% of the subsequent rebound. That's right, with the American consumer on ice in the aftermath of the biggest consumption binge in history, the US economy has drawn its sustenance disproportionately from foreign markets. With those markets now in trouble, the US could be quick to follow. Yeah? So the blah, to getting to blah plus, a lot of that, 41%, is from export. To export to somebody, they need to have the money to buy it. They need to be doing well as well. 3 regions have collectively accounted for 83% of America's export-led growth. 83%, most all of it. So those 3 regions: Asia, Latin America and Europe. Asia, the East, needs to do well. Latin America needs to do well, and Europe. That is where a lot of the blah to blah plus is coming from. If those areas go down, the blah rating goes down. That's it.